Okay, good afternoon, everyone. Mike and Corey are here today. The market's been kind of quiet today, just choppy, not a lot of exciting market news. So today we're going to hit end of year financial planning. Corey's going to talk about, and I'm going to talk about a couple articles I saw about um, jobs openings versus hiring and your debt to income ratio as a critical component of um, purchasing a house or even refinancing a house. But before we get started, this is a financial education presentation. You must do your own due diligence on anything that you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and Corey's alone. So Corey, take us away.
Yeah, just wanted to hit on a conversation I've had with a few clients recently about kind of refreshing their financial plan. Maybe some things have changed throughout the year. And
Hopefully one thing that's changed is their investments are up significantly, and that's a
well,
good change.
yeah, and you're gonna see that in just a second. Hold
Okay.
on. It's giving me allow. It is not liking this.
Well, I'll tell you
Hold
what,
on.
I'll go first and you can play around with that in the background.
Sorry. All right, thanks.
Okay, so I will share my screen. You can see the markets are choppy. I'll just say the S&P's down less than 0.1%, and the Nasdaq's up a little bit more than 0.1. So, so nothing big there. Well, I saw this article though. Job openings jumped and hiring slumped in October. And as you know, one of the key things the Fed looks at for interest rate discount rates is what the unemployment rate is, and as well as inflation. So this is one side of that story. The good news is job openings jump. So that means companies are hiring. Companies don't do that when we're going into a recession, or it's very rare, they shouldn't, unless they're trying to grow. So that's a good sign of growth. Hiring slumped. Now this is interesting, and it does talk about the ratio. If you remember about 2 years ago, there was a time when there was lots of job openings and not enough people to fill them, and people were getting, outrageous pay increases, or if you got one of them, you were very happy to get that pay increase. We don't believe we're in that situation, but that if we see that, that would be a key part of inflation if people start getting paid more. So with that, it talked about job openings are totaling 7.74 million, so it's up 372,000. But I think the important thing to look at is the ratio of unemployed workers, and it brought that up to 1.1. So basically, it's almost like there's an unemployed worker out there and there's a job out there. And then we got to figure out how to match, and it takes some churn and time. And there's 7 million of these in process. Let's just make it up. There's 7.74 million jobs, and there's 7.5 million workers. That's a good ratio. When the ratio goes any higher, when it goes to 2 to 1 or something like that with jobs, then inflation becomes a scary topic. Part of the reason why the jobs, as far as the hiring's actually slumped, and they look at, the Boeing strike that was happened a while back, the dock worker strike, and a lot of those storms that we had. So that's what they use as the reason why. I will say that, as a hiring manager of the past, as well as a person that looks for jobs in the past, December's a rough time because guess what? A lot of people are planning for, vacations. A lot of companies are like, we're not really going to hire until January 1st. We hit a new budget year. There's just December's a kind of a tricky time to really find a job. January seems to be better, in my opinion, as far as past experience. So anyways, we'll continue to watch this. We'll continue to watch the unemployment rate. I will also throw in, hiring slumped or less people. I think it's every day 10,000 baby boomers retire. So think about that. 10,000 people a day retire from their job. Some of those jobs are filled. Some of those jobs are not. So, you got this demographic trend happening as well. The other article that I saw that was very interesting, especially for people out there looking to get a new house or even refi their mortgage, although refiing at the current rates, you're probably not refiing yet. But one of the key reasons why an application denied is DTI, debt to income ratio. And it's funny because as I was reading debt to income ratio, I was immediately thinking of our government debt, what the GDP is, income. That's what my mind went to. And I was like, why can't people just do it like the government? Well, people can't print money. So that's why the government could get away with a bad DTI ratio. But for us normal non-government people, that ratio is 40%. So 40% is that threshold where if you're underneath 40%, then you're bringing in enough income that you can afford to service more debt. Now, whether you're servicing a debt of student loans, car loans, credit card, or house, or whatever other kinds of debt are out there, that all totals up to how much debt you could afford, let's say in a month. So if you made $10,000 in a month and you had 2,000 on your house loan, 1,000 on your car loan, and 1,000 on your student interest loan, that's 4,000. Like that's your max that you really should be at. The banks do make some minor exceptions, and I'm sure they only make those exceptions having to do with mortgages, just because they know that there's an asset on the other side of it, as opposed to like unsecured credit card debt. They would never want to go over that 40%. So anyways, as you do look at your plan, look at your financial situation, where Corey's going to talk a little bit about financial planning. Financial planning is like a long-term plan, but when you think of debt to income ratio and mortgage applications, that's a short-term. Like, what am I today? Not what am I going to be a year from now? What am I today? So anyways, with that, Corey, let's see if you can share your screen now and you can take the rest.
Let me know. All right, so I'm going to try to share. Let's see. I'm going to try to share a window. Are you able to see that chart?
Corey, were you able to see my chart when I was sharing it there?
Yes.
Okay. Okay. Oh,
are you able to see this one?
Go ahead and share it.
Is it not? You can't see it?
Try it again. I accidentally grabbed the screen back.
Oh, okay. Let's see. Let's try to grab this window.
And yes, we can see it. There we go.
Okay, here we go. Talking about that that kind of balance sheet, consumer balance sheet or Americans balance sheet. I came across this chart from Yardeni Research this morning, U.S. household net worth. So U.S. household assets are totaling about 185 trillion right now. U.S. household liabilities all the way down at 20 trillion, and this is a logarithmic scale, so it's not totally linear as it goes up. But then that leaves U.S. household net worth at 163 trillion, and you can see, if we go back to the bottom of the Great Financial Crisis, we were right around 60 trillion. So, this is not a bad trend, and certainly just a good thing for Americans. It's something for, it's the backbone of the economy in a sense. People's situation and standing net worth increase trend over time.
Yeah.
All right, I'm going to try now. What I really wanted to talk about today was I've had a few conversations with clients in recent weeks about refreshing their financial plan. Maybe some things have changed throughout the year, bought a vehicle, whatever, someone's going to college. And I wanted to just show you, this is just a snapshot. If you have gone through a full financial plan with us, you've seen much more than this, but this is just one slide that I really like. It kind of gives you estimated dates in the future of, hey, I'll retire in this date, my income will stop in this date, my expenses will increase at the rate of inflation starting at X amount in X year in retirement, and then I'll get Social Security starting in this year. And it just accounts for all of those things that are part of our financial journey. And so, we're certainly excited to go through these with anyone who is wanting to, finding themselves in a position where getting this bigger picture would be beneficial to them. And I just wanted to show you, if you haven't seen a snapshot like this, it's a pretty cool chart. And I found for myself, Mike, and I don't know about you, but when I'm looking forward, one of the harder things for me to conceptually grasp is I know what prices I pay for things now, but after 2.5% inflation for a few decades, what prices will I be paying in 30 years?
Ooh, I try not to think about that.
Well, me too, but those financial plans force that on us, right? And it really does give us that perspective. So I don't think inflation is going away for good. We got to be ready.
Well, I think what a big part of the financial planning is are you, I guess there's two questions. One, can I retire and maintain a decent standard of living? And then the second question based on that is hopefully when can I retire? So there's two things, and certainly it has to do a lot with the age range. I mean, if you're 25 years old, 30 years old, can you, well, certainly if you save enough money, you can retire. It's more when you get in my age range, which is the 55 to 60, where you're kind of like, is there a light at the end of the tunnel? Like, when is retirement become an option? And with the financial plan, until we really sit down and go through that and look at just an overall estimate of someone's monthly expenses, you really can't answer that question. Somebody could come to me and say, I have $500,000 in my 401k account. Can I retire? I don't know. I gotta see the full picture. At a glance, that sounds good, but if you're, underwater in your house, if you're, you got credit card debt, I mean, there's a lot of other, if you're living a lifestyle where you're spending $200,000 a year, you can't retire and have that same lifestyle. So that's why when you do the financial planning and sit down and use a software package like Money Guide Pro and put those inputs in there, we as a financial advisor can help you with that decision. So I would just say absolutely, whether you work with us or you work with, somehow you do it yourself, you definitely need to see the full picture before you can make that decision. So that's all we got for today. We'll see what happens the rest of the week as we go into the, hopefully, Santa Claus rally, although maybe it came early at Thanksgiving. I mean, November was a fantastic month for returns. So anything more that we get in December is strictly icing on the cake, in my opinion. So with that, we will talk to you later. Bye.
Bye.